Let's get to our Wrap the Week segment. So on Fridays, what we love to do is Wrap the Week, which means spend a little bit of time just seeing how the week finished off, but then focus on Friday to Friday. What sort of changes have we had? How have the trends evolved over the last 5 trading sessions? What can we do related to last Friday to this Friday? I did want to start with a poll, though, because we've talked a lot about a weaker dollar environment and what that means. And so what we asked you was, what have you been doing in recent weeks related to non-U.S. stocks and funds? We gave you 4 choices: increasing your exposure outside the U.S., decreasing your exposure outside the U.S., keeping it about the same, or I never invest in non-U.S. stocks or funds. And here are the results. 32% of you said you were increasing your exposure. 34% of you said keeping it about the same, which means 66%, 2/3 of you are keeping it the same or increasing over the recent weeks. 6% of you decreasing your exposure to non-U.S. funds, 28% of you saying you never invest in non-U.S. stocks and funds. So my observations on this, I mean, overall, I think you can pick up on, if I was answering that question, I would certainly be leaning toward increasing my exposure only because it's all about the weaker dollar. And if you look at the chart of the dollar, you've seen this incremental weakness, sort of this pullback in the dollar after the volatility in February to March. You had the sort of sell-off May into June, and then this what you call a bear flag pattern resolved to the downside, and that usually happens about midway through a downturn. This isn't updated for today, but the dollar came off a little bit today as well if you look at the UUP. So overall, this weaker dollar environment in general will tend to favor stocks outside the U.S. versus U.S. stocks in general, right? I mean, there are many different moving parts to that relationship, but a weaker dollar certainly is a tailwind to outperformance of non-U.S. stocks. And if you look at the relative performance of the two, you can see that the U.S. has been underperforming non-U.S. stocks. So the reason when I bring this up, if you do buy into this weaker dollar thesis that we've talked about and that some of our guests have gone through, if you feel like that may continue, that would be the question I would be asking. What is my exposure to non-U.S. stocks, and how can I best express a weaker dollar environment in my positioning? Let's continue on, just sort of wrapping up today's session. We'll get to the longer term chart. So the S&P, as I mentioned, really I think the key story today hit 3232, right about there to the penny, came off a little bit. If you look at the daily chart of the S&P, you can see this level we've been talking about. This is the resistance level from the end of the first week in June. We retested that now twice in this week already, and then today, once again, we got right up to that level and closed below it. So until we can close above there, and I've sort of talked about 3250, just meaning we've at least gotten through the level and confirmed a close above that previous resistance. If we can do that, I think you can buy into the S&P returning to previous highs, S&P 3400 plus. I think you have to assume that that's a very real probability, but until we do that, we just haven't had the upside follow through. And what's interesting is, as this is happening on the S&P chart, we're getting the sector rotation that we've been talking about as well. So today, on a day when the S&P's up 0.28%, utilities up over 2%, real estate up 1.4%, then healthcare 1.4% as well. Materials number 4. On the downside, energy, financial. So what do you not see at the top of the list? Technology, consumer discretionary, communication services. They're all sort of middle of the road right now. Tech outperformed by a little bit, but halfway down the list of sectors for the day. So overall, we've had this theme this week of a rotation, started Monday, rotation away from mega cap tech into other places, and what it's been flowing to are things like utilities, materials, healthcare, things like biotech, REITs all getting a bid today. Where it's not been going is technology, is energy, some of these things that you've seen rotated back onto the lower end, financials as well, as I mentioned, coming off a little bit. So mid caps up a little bit more than the S&P. Small caps flat for the day. So small caps actually were the worst of the 3. Just very quickly wanted to point out bonds weaker today, gold stronger. So at a time when stocks finished higher, gold actually opened higher and continued to chip away, finished more toward the highs of the day, up almost just over 0.8% with the GLD going to 170. So overall, I think the base case of what we've talked about is, are we able to eclipse this resistance level? I'd like to see 3250 on the S&P, which for me would clear the way to go to the previous highs. Let's look at some of the longer term charts and see what conclusions we can draw on last week's Friday close to where we're at today. We're going to look at the Mindful Investor Live chart list and start with the long-term trend of the market. This is a market trend model I've been following for a number of years, and it essentially is built on exponential moving averages. It has three components: a long-term component using the 21 and 34-week moving averages. This turned positive in June and has remained positive through this week. The weekly PPO using the traditional settings, that turned positive in mid-May. And then the short term is looking at just a change in those moving averages. That turned positive about a month ago, 3 weeks ago, and has remained positive as well. So, according to this trend following model, again, I don't, I wouldn't automate anything based on just what I see here, but it gives me a bias with which to view the other charts, right? In general, when these are all positive, I have to be assuming that the weight of the evidence is more positive in general. All else being equal, things are going to start drifting higher before they drift lower. When these things start to turn down, and it would start with the short-term indicator, which would be the spread of these two moving averages would narrow a little bit. That would be the very beginning of some sort of internal weakness, and you haven't really seen it yet. Overall, it's they've all been positive for for the last month now, and have remained so through today, closing higher than we were last week. The daily chart we've already gotten to, and I think going into next week, we did not get a breakout this week, breaking above resistance, which for me still means, again, the trend has been positive leading up till today, but we're up against major resistance, so it feels like the risk reward is not super attractive on the upside, given the fact that we're unable to get above resistance. This next chart is looking at the cumulative advanced decline line, so it's a measure of breadth across cap tiers. So it's mega cap or large cap stocks, the New York Stock Exchange, broader universe, mid cap index, small cap index. I color coded these last weekend as I was reviewing these charts. You can see I had them sort of like a stoplight. The large cap breadth breaking to new swing highs, the mid and New York Stock Exchange breadth sort of flat, and the small cap breadth breaking down. I have to put these other ones back in sort of the neutral category and would probably turn them positive if they break to new highs, if they break above the June highs like we saw from the S&P. So I think at this point, you'd say large cap remains positive, mid, small, and New York Stock Exchange, broader universe, all neutral. So not positive yet, and again, you still haven't had that follow through with mid and small caps that you might want to see right about now. What this leadership rotation has certainly caused the breadth on small caps and mid caps to turn higher, as they've done a lot better this week than we've seen in previous weeks. So that'll be certainly a theme to pay attention to going into next week. In terms of new highs and new lows, we've seen a consistent number of new highs over the last 2 or 3 weeks. And it's not been a ton of companies. It's been 20 to 30 stocks in the S&P every day that, on average, have made a new 52-week high. That's not a huge number, and it is not similar to what we've seen in previous bull cycles. Usually, coming out of a base, breaking out, you'd see a big increase in this number. The challenge is we're in this big February to March range, and most things remain in that range. So I don't see that, really appreciating dramatically. But again, in terms of weight of the evidence, this number increasing would be one more way to validate a potential return to S&P 3400, because what that would tell you is that a lot of stocks are already testing their January, February highs and breaking to new highs, like some technology names obviously have already done. The more that number goes up, the more you're seeing other types of names, especially as tech has pulled back a little bit. For that line to go up, that would have to mean other groups and other sectors are starting to improve, and that would change the dynamic of what we've seen a great deal. This is a chart we've talked about and referred to a lot this week, and it's looking at the percent of stocks above their 200-day moving average, above their 50-day moving average. Not updated yet through today's close. This is through yesterday's close, through Thursday's close, but Wednesday, Thursday, that's finally got back above 50%. So 52% of the S&P as of Thursday's close above their 200-day moving average. This is one of the lines in the sand I'd been mentioning for quite a while. I would feel much more comfortable being bullish on the market if this line is above 50%, because if you look back over the last 10 years, cyclical bull markets tend to be met with this indicator being above 50%, because most stocks are above their moving average in an uptrend. Cyclical bear markets are met with this line going below 50% because there's weakness and stocks are going below. We've now gone back above. The last time that happened, it whipsawed and came right back down. That was that early June high that we've talked about earlier in the show. If this remains above the 50% line, I think that should give you more confidence that the weight of the evidence, more positive potential for further upside. If for some reason this would rotate back lower, that takes that away as a positive catalyst and would make me be a little more skeptical. You know, an interesting reading this week on the Bull and Bear Index. This is the AAII rating, so the survey of individual investors every week. It actually spread out a little bit, so the ratio is about the same. The difference between the two is about the same, 45% bearish, which is an increase from last week, 31% bullish, which is an increase from last week. So essentially what happened was people moved from neutral to bullish and bearish. Certainly could have been some, change around those votes, but basically you have more conviction, but it's on both sides of it. So more bulls, more bears. There's still, it's about a 3-to-2 ratio of bears to bulls. So still overwhelmingly negative relative to positive, but the numbers actually spreading out in both sides. It's actually kind of an unusual pattern there. The ratio of consumer discretionary to staples is the way I look at offense versus defense. I would just point out that over the last month, you've seen this reversion away from consumer discretionary into consumer staples. The cap-weighted ratio tells that story a little bit. The equal-weighted ratio really drives that story home because it takes the Amazon and Home Depot overweights out of consumer discretionary, and it's a better read on sort of the average stock in each universe. You can see that it's been favoring consumer staples for the last month now. It ticked up a little bit this week, and interesting is it actually ticked down as Amazon sold off along with the rest of the FANG trade. So overall, it's an interesting ratio to watch. Consumer discretionary is starting to outperform technology over the last week and a half, but overall, it's still relatively muted over the longer term. The long-term trend has seriously been, or has consistently been favoring technology. Semiconductors on a relative basis pulled back a little bit. Overall, still in a primary uptrend, and this group is important because when these stocks are doing well, the overall market tends to be doing well because they're such an integral part of how we operate and how businesses operate. So overall trend remains positive. Certainly pulled back this week after a spike higher, but overall primary trend remaining to the upside. This is a really interesting chart, the way that this has evolved. This is the relative performance of small caps, the Russell 2000 versus large caps, the S&P 500. You can see the downturn in this ratio going into the March lows. It actually came up, and for the 2 or 3 months after the March low, it's been actually in a nice uptrend, showing overall an outperformance of small caps versus large caps. That all changed, and last week when we had this discussion, we talked about this reversal back to the downside. And all of a sudden, this looks like a bit of an upturn before the next leg down. This actually turned around and rallied back up a little bit. So this ratio of small cap to large is kind of in limbo of sorts. Overall, though, I'm seeing lower highs and lower lows, and until we break above the most recent swing low, it's suggesting overall that that remains relatively weak in favoring large caps over small. That's our review of the Mindful Investor Live chart list. Again, we have this stored right on my homepage, The Mindful Investor. Go to that blog and you have a link to go to this chart list, save it, do whatever you want with those charts. But that is our take on the long-term picture and how it's evolved over the last 5 trading days.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.